So once again, good evening, everyone, and thank you so much for your patience. Thank you for waiting. I see a lot of people joining now, but we'll start our sessions. Today, we are talking about investment strategies in volatile markets. We have done uh, these sessions before. We have discussed about a few strategies before, and most importantly, first of all, before I start, please let me know if you can. Let me just switch off the cam before. Yeah, if you can. See my presentation. If you can hear my voice clearly, please use your chat options, write a yes or a okay, so I can proceed further. I just want to make sure that there are no connectivity issues here. Please, if you can hear me properly, use your chat options. You can write okay or yes. You can hear me. You can see my presentation, and please let me know. Okay, perfect. So I see a lot of people have started joining, and great. So we'll start this session today, and this is going to be about trading strategies. Um, Whatever we are going to discuss in this session is for information purposes only. Please do not take any of the information as a recommendation or as a trade, because markets are really volatile at the moment. And what we need to understand is that how to capture different styles of investments, how to capture different ways of investments, and understand them, that there are a lot of avenues apart from the trading and speculation, because today markets are so choppy, and it's not just today. Every year, every month, one or the other event is always there. So if you try to remember, um, this is 2022, so it's all about high inflation, right? So investors, they're freaked out because markets are going down, and where to invest in inflation, and a lot of that. But in 2021, it was something else. In 2020, it was the pandemic. In 2020, it was elections also. In 2019, there was a talk of elections also. In 2018, we saw the trade war between US and China, right? In 2016, we saw US elections and Chinese markets falling down. So happened in 2014. So every year there is something going on always, because whatever you invest in, whether it is a commodity like gold, silver, or oil, whether it is a currency like euro, pound, whether it is a cryptocurrency like Bitcoin, for example, all of that are impacted by what's going on around us. So from um, pandemic across the world, to US elections, to UK central bank decisions, every single thing affects your investments. So best way always, which I always say, that the biggest mistake what investors do during such volatile times, they get away from the market, which means then they don't invest, which um, I'm sure a lot of you sitting here now have seen investments from different ways. I'm sure a lot of you must have your fund managers who are taking care of it. Some of you are already into that line of area and expertise. And that's why I can sit with confidence and say that you know what I'm saying when I say that there is no such thing as being away from the market and not investing. You have to invest somewhere, because that's what helps your money grow, especially in the times like this when inflation is at its peak. And when I say invest, I don't mean to say that you should trade and speculate always. um, there is something called diversification, which allows you to spread the risk into different instruments. Like, tell me, use your chat options, how many of you have investments in real estate here, India, Pakistan, anywhere across the world? How many of you have real estate investments? Guys, use your chat options. You can. This is the only mode of communication we are having until we meet one on one in the office. But definitely. Use your chat options. Tell me how many of you have real estate investments. It doesn't matter whether in UAE or any other part of the world, as long as you have a real estate investment, right? I think a lot of you said yes, yes, yes. Okay, yes. Um, in 2010. Okay, okay. 2010. Okay, okay. One in India, one in UAE. Fair enough, fair enough. Right. So a lot of you have real estate investments. Now tell me, how many of you have investments in bonds? If yes or no, there's one answer to it. Either yes or no. How many of you have investment in bonds? Bonds are promissory notes which allows you to receive a fixed coupon and your capital is promised by the end of the year. Somebody said, does a house for self-use qualify? Does a house for self-use? That's a very good question. Does a house for self-use qualify as an investment? So, I mean, it's your. So I'll tell you the technical part of it. I work with the wealth divisions also here. Century also has a wealth division in DIFC. And whenever we have to onboard a client in DIFC, the DFSA has very strict regulations that we can onboard wealth clients who qualify for a minimum net worth of $1 million, what they call as professional clients. And to qualify the net worth of $1 million, you can submit your bank statements, you can submit your real estate investments, title deeds, gold certificates, jewelry, ornaments, whatever the evidential proof of you telling us that we have $1 million net worth, not necessarily the cash, it can be in the form of gold certificates, jewelries, real estate, title deeds, and everything. And for them, uh, anyone having a real estate, uh, which is a primary residence, also like what you just asked, sir, they don't count that in a net worth because they are looking for liquid or bankable investments. So mostly their notion is that you're living in that house which you have purchased. If you were to, if the value goes up, will you sell it right away and get another one? I mean, not everybody's going to do the same thing. Basically, primary residence is not included by DFSA. What I personally feel also is that whenever we purchase a house, a very few of us, and again, when I'm talking to you, I'm talking to all of you, and again, we can have very different opinions. Mostly, it's about if I'm purchasing a house and if I'm living in it, the increase in value will not encourage me to sell it. I mean, that is something which is always, it's more closer to my heart. But what you just said, probably the option to move or to a rented house. Like I have two real estate properties here, and all of them are mostly on rent. So for me, that is an investment because my primary residence is something else, but my real estate portfolio comprises of at the moment two of here and one in India and otherwise. But all of them are on rent. So I consider that as an investment because when needed, I can uh, either add more to it or get rid of it, whatever it is. But that doesn't affect my current position. So, but then again, it's all about how you perceive the investment part. So there is no right and wrong here. We're just clarifying the technical perspective in this. I would always be more happy if the place I'm living, the that stays the way it is, and I would work to make more money so that I can invest into a different real estate, which I can probably get a rental income in the future from. So that's how I want to increase my portfolio. And again, I'm sure a lot of you will have different thoughts on that. But yeah. Now, similarly, tell me how many of you have invested in bonds? Bonds are these promissory notes which allows you to purchase, which allow you to receive a coupon every year by the issuer of the bond. And after a stipulated time period, the bond matures, you get your capital back along with a certain interest, right? Anyone, you can write yes or no on your chats, and we'll be more than happy to provide you the perspective. right? Okay. No, 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 no. Okay. One person said yes. Okay. Yes. No. Yes. Okay. So, okay. Now, third questions. Yes. Bank fixed deposits. Okay. How many of you have bank fixed deposits? So, fixed deposits, bonds have slight difference. Um, I mean, this basically the structure is same. You get yearly interest, but and it matures after a certain period of time. But bond, you can sell it anytime you want. There is no such thing as a surrender charge or anything. Okay. And how many of your investment in stocks, shares? All right, all right. Okay. So a lot of you have investment in shares as well. Perfect. Now the whole idea is why I'm asking this because at the end of the day, diversification is the key. You can have as many real estates you want, but at the end of the day, if tomorrow real estate market goes down, then your money is blocked in an asset which is very illiquid, right? Um, when inflation comes into the picture, real estate and stocks are two asset classes which can help you possibly beat inflation or save your money from getting eroded by the inflationary effect. How that works is when shares are basically companies you're investing in. Companies make products. Products are made through raw materials. So when things start getting expensive, that cost is passed on by the business to the consumers, and that's how uh, the company's stock value starts growing. So basically, stocks and real estate are those two asset classes. The thing is, there are asset classes which are more liquid than other. And when I say more liquid, that means which can be easily converted into cash. Real estate cannot be very easily converted into cash. Today, if you buy a house, you want to sell it tomorrow, you cannot. I mean, you always can, but tell me what are the chances of that happening, right? But if you buy a share today and in the very next 10 minutes it goes up in value and you want to sell it, you can. So the idea is that you should have a diversification where if you're trading and speculating, that is one area. Second is your bonds investment, which gives you a fixed income. Then third is your real estate, probably, which allows you to invest into the properties, probably receive a rental income when things starts working out. And then there is something called stocks and shares, where a lot of us invest. And then there is another leg to all of it, and that is called a strategic form of investment. Now, that is something what a lot of fund managers, hedge funds do, but a lot of traders and speculators, they don't look at it. And especially us investors, plus, who are always looking for opportunities. A lot of times, either by emotions or through panic, we always get distracted to what is flashing in the media, what is hot. So what we have to understand is there are a lot of such strategies which are built around the same products which you're already investing in, or if you have thought about investing in. And we are going to discuss today about those products. Now, to give you an idea, what has happened in throughout this 2022. As I said, that every year has something significant going on. Uh, this year, what we are calling it as a bear market story, it all started when inflation started reaching high, a 40-year high. And we saw the impact of that in October 2021 when the technology stocks started falling down. We saw technology, we saw stocks, we saw cryptocurrencies, and all of them started coming down. And in the beginning of 2022, the fall was even much more steeper, and we have seen S&P 500, Dow Jones across the globe, markets have continued to fall down. And I'm sure if you are the investors, you all have been looking at your portfolios. If it is in red right now, you're not the only one. A lot of us are feeling the same pinch. So do not blame yourself or anyone else. The whole idea is the markets are very tricky right now, and that's why we are always discussing that another leg which you should have in your investment briefcase, and that leg is strategies, right? So we have seen markets going down due to inflation, and inflation was caused, first of all, a huge rise in the commodities. We saw commodities like sugar, coffee. We saw crude oil, gas prices, which have skyrocketed, and that is another one of the reasons that why we have seen inflationary conditions piling up, and the resulting to which US central bank and all other central banks, they decided to increase the interest rates, which will reduce the supply of money and make dollar more stronger. So basically, when inflation goes too high, above the central bank's target, what they try to do is control the supply of the money. Now, controlling the supply of the money can happen either by increasing the borrowing cost. So today, if I'm an average consumer and I borrow money and put invest into my business, I'm doing that because for me the borrowing cost is cheaper. But the moment these interest rates go up, I will borrow less, and I will borrow less, which means the economic activity across the world. Think me as a consumer, then think millions and billions people like me who wanted to borrow, but they're not borrowing due to a high borrowing cost or higher interest rates. So when that happens, it reduces the supply of cash. It reduces the economic activities also. That's why high interest rates, they make stock prices a bit jittery, and stock prices come down, but dollar becomes more stronger. A lot of currencies which are valued against dollar at the moment are on the weaker side because there are a lot of other events happening. So this is the reason that we have seen markets going down, dollar getting stronger. Gold prices which were valued against dollar have come down. You will see euro as a currency has dropped more than a dollar. Earlier, you could buy €1 if you pay $1.2, and now the same euro has come down to 0.97. And pound is also going weaker. If a lot of you I see are Indians over here, so even the Indian rupee has fallen down, and we have a strategy for our expatriates who are from India. I will share a strategy with you as well. What we have been noticing so far. Now, um, if you can, if you just look at it, these are the global markets, and we are looking at the European market, we are looking at the US market, we are looking at global indices, and we have seen that how the prices continue to fall down. And there are 2, 3 good days where we see markets going up, but uh, overall, when we compare the market from 2021 and 2022, yes, we have seen a decline in the stocks. A story which never gets old: the fall of Bitcoin. How many of you have invested in cryptocurrencies? Please use your chat options. Tell me. I will start. I did so because had a big fear of missing out, and I'm sure a lot of my friends over here have. And do not shy away if you have done or bought bitcoins or any sort of any cryptocurrencies, not just bitcoins. Tell me, guys, how many of you use your chat options? Okay, okay, okay. This is actually really interesting. I'm actually talking to a very informed batch at the moment. Okay, okay, okay. Perfect. So it's like a 50-50 percentage what I see right now. Yeah, a lot of you have invested in Ethereum and still remain invested. That's really good. Bitcoin, very few. So just to tell you the idea, this is the fall of Bitcoin. Always remember this: times like this, when inflation is too high and markets are very jittery, the riskiest assets are the first ones to fall down. And exactly what happened with Bitcoin and the other cryptocurrencies. So whether you talk about Ethereum, you talk about Litecoin, you talk about Cardano or Luna or Terra or whatever cryptocurrencies you have been investing in, the overall crypto market is down at the moment, and it has plummeted uh, whenever I'm meeting any investor at the moment, a lot of them have actually talked about that how we should not put more than 1% of our net worth into these kind of risky assets, something which has been a very popular thought in last few months. So be very careful because Bitcoin has fallen down and there is no hint of whether it's going to go back or it's going to fall down. It's still very gloomy, the outlook. Now, starting with, so the whole idea of telling you what has happened so far and what is going on with the assets, um, the idea was to bring you to a point where I can start sharing you a few strategies which we have been doing for some time. And as I said, that these strategies are not a form of recommendation. These are not a form of, you know, a tip or anything. Um, any person, it's a very popular joke amongst our the analyst bay that anyone who makes money in tips are the waiters. So there is no such tip over here, but I'm going to give you a lot of information about how these strategies work and something called pair trading. Pair trading is done through using two products, and these two products can be something very similar. These two products can be sometimes really different, but still one of their attributes connect to each other. Now, it can be something really opposite, like two products are so opposite that it become a pair, or two products are so complementing together that they become a pair. And I'll give you examples. Tell me what word comes into your mind when I say Pepsi. Use your chat options. Okay, okay, okay. Right. Okay. I wish I could actually show you the results. Almost everybody said Coca-Cola, which means we're on the same page. Somebody did say Mountain Dew, and I respect the thought. Right? And similarly, when I say MasterCard, the very next thing comes to your mind is Visa. These two companies are so connected. And when I say connected, which means they have the same target market, they have the same regulatory environment, they have almost the same product. So the prices of these products they move together most of the time until one of the company or one of the stock prices would deviate from its historic pattern, and that's where the strategy comes in. Now I'm going to show you one example, and this is the strategy which we did last 2 years, and it worked well for us. And this is only for your information. I'm not recommending you to do this at the moment. Any investments you do, please talk to your risk consultants, talk to your researchers, and only then enter into any of this thing. This was a strategy which started between two markets, and one was US, another was South Africa. And we picked one index from both the countries. From US, we picked NASDAQ, and from South Africa, we took the South African index. NASDAQ is a tech-heavy index. A lot of technology stocks, around 100 of technology biotech companies, they are clubbed into the index together, and that's how if the companies perform well, the index value goes up. If they don't, then the index value goes down. And South African index is South Africa 40, which is tracking the performance of 40 major South African companies. So just like in India, there is Sensex, there is Nifty, which tracks the performance of a bunch of companies, and you can invest into those. Similarly, you can buy and sell Nasdaq and South Africa. Now, I'm going to share the strategy with you, and I'm going to show you a pattern, and just have a look at it and see for yourself that how these things work. Okay. Please let me know when you start seeing this. So this was something which was created back in January in the beginning, right? Okay. Now I understand there are a lot of numbers. You don't have to see all the numbers. You just have to see what I'm showing it to you. Okay. Right here. Okay, first tell me, can all of you see this PDF on your screen clear? Can all of you see this PDF clear? Please send me a yes. Okay. Okay, yes. I'm absolutely not here. I will not. So somebody just put up a thought that do we have to read all these numbers? No, no, you don't have to read all these numbers. Just tell me if you can see this clearly, and I'm going to show you what you have to see. And then we're just trying to identify a pattern, and that's how we are going to explain it to you how strategy works. And we're also going to show you that how you can use the trading platform to execute these kinds of strategies, right? So all of you, can you see these strategies? Okay, perfect, perfect. Now, on the left corner right here is the yearly performance of NASDAQ. When I say yearly performance, we are looking at, say, a calendar year. And by the end of the year, whether NASDAQ was up or down. Okay, I'm going to zoom this one. Okay, now this is NASDAQ yearly return. And this is a statistics from 2008, which means almost 10, 14 years we are counting this. Look, from 2008, NASDAQ showed a negative performance, minus 42%. And then straight away, in 2018, it was down by 1.6%. And then again, this is 2022 still going on, so we have to check what because this was created in January, but now I'm sure it must have gone down also. So if we see that NASDAQ from 2008 till 2022 has been negative, let's take 3 times, including the current phase, right? But other than that, NASDAQ has mostly been positive. And let me tell you, NASDAQ is a tech heavy index. We are looking at all the Microsoft, Amazon, Tesla, Google, Facebook, Netflix, all those sort of companies, right? Now, that was statistics number one. Now, just next to the column is South Africa. Now, just look at the South Africa yearly return. In 2008, it was down 26%. 2011 down by 1%. 2016 down by -4. 2018 -11. And year till date, I mean, this was beginning January, so say 3%. Positive, not negative. Now, these two indices separately does not make any sense, right? Nasdaq has its own pattern of going up and down. There is no similarity in numbers. But and before I explain you the strategy, how many of you understand how short selling works? Let me put a poll. New poll. Second. Okay. Or edit it. Do you know short selling? Right, you have a poll on your screen. Let's use that. How many of you know how short selling works? Because a lot of these major strategies, we call them market neutral strategies, we call them statistical arbitrage, we call it a lot of names, but all of them have one element of short selling. And that is the reason that you need to know how short selling works to understand all of these strategies. All right, okay. Okay, it's more 75-25. So for those people who don't understand how short selling works, I'm quickly going to give you a small brief. Short selling means taking advantage of the falling prices. So today, if you feel that the price of this bottle of water is going to increase, you buy the bottle of water. When price goes up, you sell it. But what if the price of the bottle of water was already high and you expected that the prices are going to fall down? Under that case, what happens is you borrow the bottle of water, right, from your friend, from your neighbor, sell it in the market, get the money, and wait till the price comes down. When price comes down, you use that money to buy the bottle of water at a cheaper price, give the bottle of water back to your friend, and keep the price difference. That's how short selling works. Of course, if you want to know more about short selling, we can have one-on-one session and I can explain it to you that how it works. But all these strategies works in the similar way where you buy one index and you short sell another. And the reason being, now you come to the third column, and that is the most important column. Just look at this. The third column is all about that instead of investing in NASDAQ separately or investing in South Africa separately, what if you had bought NASDAQ and short sell South Africa? So when you short sell South Africa, you expect to make profit when South Africa goes down. And when you buy NASDAQ, you expect to make profit when NASDAQ goes up, right? The performance you will see, because you will see that most of the time NASDAQ outperformed South Africa, except leaving a few occasions. And 2000, but this is the most important part. I'm going to zoom this so you can look at this and you will understand what strategies are all about. 2008, NASDAQ went down by 42%. South Africa went down by 26%. If you had bought NASDAQ, you would lose 42%. But if you short sell South Africa, you would gain 26%. So your net loss would go down to 16%. Now, one thing which you should understand about investments and strategies and whatever is the purpose of your fund manager is not only to make profit for you or your money grows. Of course, that is the end agenda for everything, and everybody is happy if that happens. But in the event when market crash happens, when recession steps in, when losses happen, how, as an investor, you minimize your loss, right? This is a really, really important thing, guys. This is a really important thing. How do you minimize your loss? Today, I'm sure a lot of portfolios, all of you investors right here, if you have portfolios, you have seen a lot of red, right? But now when you sit and see, how have I taken all these steps to make these losses smaller? Because you're not just a rational investor only if you make money. You are a rational and you're a capable and a intelligent investor if you reduce your loss, because loss and profit, these are two sides of one coin. If you invest in a business, either there is going to be a profit or there is going to be a loss. So as important it is to bag your profits, it's also important to minimize your loss. Take all the necessary steps to manage your risk and keep your loss to the minimum, right? You cannot just panic and say, oh, why I'm seeing red in my portfolio. You are definitely going to see red in your portfolio because nobody can time the market. And even the best of the best fund managers will give calls which are going to be absolutely wrong, because we look at statistics, numbers, and historical patterns. But then there are things like Russia, Ukraine, there are things like Donald Trump tweets, there are things like midterm elections, there are things like energy crisis, there are things like recession, and that happens. And sometimes, and there are things like Elon Musk. There are people like Elon Musk who, with a single tweet, can decide the fate of any financial instrument. So all of these uncertainties, we need to have a support. We need to have strategies which can minimize our loss. And this strategy was one of those which was initiated. And if you see the results right here, and I'm just going to scroll it up and show you. So obviously you can always argue that, okay, in 2009, if I had invested in NASDAQ, I would have made 53%. Or if I had bought South Africa, I would have got 29%. But with the strategy, I only made 25%. But look at the risk managed point of view, that if you only buy, or if you only short sell or only buy, which is called a naked trade, the chances are there is a 50-50 point where either you are going to make money or lose money. When you use a strategy, you're trying to calculate your odds. You're just trying to play with the odds that, okay, if these are two indices, if one goes up and another goes down, I will definitely make money. But if both go down, wouldn't my net loss will be less, or maybe my profit is less, but my loss will also be less? And that is what strategies are all about. That is actually what investments are all about. It's not just about making money, but it's all about risk management and minimizing your loss. So if you see from then, from 2008 to 2011, it has been very rare that South Africa ever outperformed Nasdaq. Nasdaq outperformed South Africa most of the times. Look at this: in 2010, in 2011, then in 2013, 2014, 2015, 2016, 2017, 2018. Look, 2018, where South Africa gone down by 11%, but Nasdaq only fell down by 1.6%. Even that is outperformance. 2019, 2020, 2021, and then 2022 beholds. So the idea of a strategy is when you buy one and short sell another. If there is a history, if there's a pattern that one index has outperformed the other, then that particular trade can be a better trade than a speculation, right? Obviously, at the end of the day, there is never going to be a guaranteed return. There is never going to be an assurance, and I never use those words, and I have a serious problem with people who do that, because when it comes to stock markets, there is no such thing as guaranteed return. There is no such thing as an assurance. You will always be playing with the odds. Managing a risk well, and strategies like this are going to be very helpful. That's why we call them market neutral strategies. We call them statistical arbitrage. You can give it whatever name it is, but it's all about having a pair trade where you buy one and short sell another to reduce the impact of a market crash. If you make a profit on that, that's really good. But at the end of the day, as you can see in this strategy, that not all years are same, but then majority of the time, we get the benefit of these strategies. So we have to be obviously very careful. It's not that strategy is always going to work out, but then, as I said, that while we are investing in a lot of asset classes, a lot of us are away from these strategic investments, which a lot of times either the hedge funds do not disclose, or it looks more sophisticated. Probably a retail investor would think, oh, these are too many numbers, I cannot do it. And that's why we are here. When you meet us, when you come to us, we sit with you one on one. It doesn't matter whether you're a client or not, but if you want to understand and learn about this, we are definitely very open to speak with you, explain it to you, not only uh, what the strategy is, but also what are the risks behind it. If you have this X amount of money, how you should execute the trade, what you should be looking for, how much time it takes probably for one strategy to give you the result, at what point you should book your loss, get out of it, wait for another strategy to kick in. So all of these things are important, and a financial analyst does all of that, and that's why we are having this session. So this was one strategy which you can, and again, as I said, this is only for your information. uh, there are a lot of strategies built like this, and it's not just in indices, it is between. So there are two kinds of crude oil, and both of them have a different prices, right? But that price difference is, let's say, this much, and historically we have seen that this has been this much, right? So a lot of times we have uh, traded in a oil strategy where we buy one oil, we short sell another, and we only bet on the price difference rather than on the actual price. So it prevents uh, the investor from losing money or losing big money when the commodities market fall, because energy prices at this point of time are very volatile. OPEC meetings are happening. There is the energy crisis going on in Europe. So you need strategies more than ever, rather than taking just naked trades in crude oil and keeping a stop loss, right? Now I'm going to show you one more strategy. That there are a lot of them, but then now this one is called seasonality analysis. And again, as I said, that uh, you have to play with the odds. Every single call, every single strategy which comes to you is based on the historic pricing, trying to identifying patterns, right? So when it comes to a seasonality analysis, now this description, what you hear, it's about platinum, but we have this was a strategy which was really old, and there were few more strategies which we had done with seasonality, and I'm going to show you which other strategies you can look into. Let me just switch on to Okay, right here. This was the one which we did in February. Once again, let me share with you again. Okay, tell me if you can see this. Come on, guys. If you can see the strategy, send me a yes. Okay, so I can proceed. Okay, okay, okay. Please let me know if you want me to zoom in or increase the size of my screen. I'll be happy to do that. Okay, so far I think no complaints. Okay, great, perfect. Everybody can see this, right? Great. Now, seasonality analysis is as the name suggests, season, right? Not only seasonality analysis is done on agricultural commodities. I mean, this is a perfect example. We are doing a seasonality on sugar at the moment. I'm showing you a strategy on sugar. But apart from that, seasonality can be done on precious metals. It can be done on indices. All the essence of seasonality is that how much extensive data you can get. And our research, and I'm sure not just my research, but research around the world, anybody who creates these strategies, and I'll speak about my research department here. These are the bunch of people who are sitting day and day night, exhausting data from Bloomberg, and why this sort of data and statistics is needed for these kind of strategies. I'm going to show you now. So let me zoom this so you can see both the aspects of it. This is the performance of raw sugar, which is traded on the exchange. By the way, a lot of investors they trade sugar. This is the statistical performance of sugar from 2006, and we did this in February 2022. So consider 15 years of sugar performance month on month. This is important, guys. Month on month, how sugar has performed over last 15 years. You cannot just Google this data and get it. You cannot just Google the heat map and get it, because the authenticity of the statistics, the authenticity of the data is important. So we, as a research department, we get it from Bloomberg, which is again a paid service. But then that's all it is about. It. We have to give the best of the work. We have to spend money over it. So our research guys, they're sitting day in day out, finding out these sort of strategies, finding out these data. And if you see, all seasonality analysis is about understanding that how sugar prices uh, perform every month. And the way to see this is that look out the last 10, 15 years of how these prices have performed in every month, so that if we can find an identical pattern and increase the odds towards us. And what we realized was, look at this. If you can notice this, it's just a heat map, and there are 2 months which you should definitely look into. One is March, right here. You can see a lot of reds. And then there is another one which is June, if you see right here, right? And if you see in March, most of the time sugar prices are on the lower side. Look at this. 8% down, 10% down, 26% down, 2%, 7%, 12%, 13%, 30%, 20%, right? And then when you see in June, most of the time sugar prices remain higher, 30% up, 16% up, 9, 4, 7, 13, 13, 14, right? Right. Now let's understand the fundamental point of this. The price of sugar reaches its lowest point between March and May due to the fundamental factors of weather and harvest cycles. The low point generally coincides with the peak harvest in Brazil, the world's largest exporter of sugar. Harvest results in nearly a full year's worth of supply coming to the market in a short period of time. And that's why there is so much of supply. It causes the price of sugar to decline in the lowest point in this cycle. And then when you see back in March and April when they go down, and then the prices starts recovering in June. Just have a look at this. This is exactly how sugar has been performing, and you see most of the time in March the prices are down and then it recovers here in June. Now the point is, I get a lot of queries, I talk to a lot of clients, and sometimes they say, okay, we don't want to trade and speculate every day, we don't have that much amount of time. But if I were to invest in something for a month or so, or take a trade for a month or so, what would that be? Now that's where the seasonality analysis comes in. Now this is just for sugar, right? Is it 100%? No. If you see even the seasonality, there are 3 points where the prices did go up, right? But most of the time, as I said, that it's all about the game of probabilities. It's all about looking at the statistics, and risk management is something which is important. Now you think that within your portfolio, and I'm not talking about real estate or anything, let's say if you're investing in markets, right? I'm sure a lot of you are only investing in Indian mutual funds, for example, or gold funds, or dividend funds. But if you don't have a separate leg which is related to these sort of strategies, pair trading, seasonality analysis, a lot of other strategies, if you don't have that, then you are missing out on one important thing, and that is risk management. See, each one of us can just buy and hold the stock and wait for it. But then there are always opportunities in the middle of volatility. Volatility means fluctuations up and down, but fluctuations do not just mean that we have to be away from this. Fluctuation means that there are opportunities which can be tapped, but we have to see our risk appetite. We have to find the right strategy to step in. And again, as I said, this is only for your information. We are in the month of October, so obviously this seasonality wouldn't apply to this. But this is just to show you the kind of work can be done and the kind of strategies which exist. And this is really important because for those investors who don't like to trade every day, who um, always want to be careful for the opportunity, strategies is something which gives you better odds to invest, right? And when I say better odds, again, I don't mean profits. When I say better odds, I don't mean assurances. It just gives you an idea that, okay, earlier I was not looking at sugar at all, but when I look at the statistics, okay, probably I can short sell and get some advantage, or probably I wait until June and then start buying in April or May, and then recover when the prices recover in June, I can get some benefit. So like this, there are a lot of seasonalities which happen with corn, which happens with wheat, happens with coffee, happens with sugar, happens with orange juice. Then in commodities, it happens with platinum, palladium, gold, and a lot of that. So we are constantly speaking with our clients. We are telling them these are some sort of strategies. And if you want to learn and understand more about this, I'm more than happy to sit on a one-on-one session with you, right? Now, coming to a strategy which we recently came up with, and it is more than strategy, it's some observation which I would like to share it with you. And this one is going to be here. Yeah, I think this is something very, very recent. Yeah, 14th October, it says. And as this is closely connected to the inflation, and I'm sure there are a lot of people who are having fixed deposits, and this is specifically for people who are from India or doing fixed deposits in INR. Even a lot of NRIs over here who are available, who are doing this. Just have a look at this and look at the narrative. I'm just going to read this out for you. And if you are interested in any of these strategies, you can ask your relationship managers to get these flyers. And as I said, before even doing any trade or doing anything, please come down to the office, sit with your risk consultants, sit with your risk managers, talk to them until you understand the risk or the loss which could happen. Until then, please do not use these strategies, right? Now, fixed deposits is often regarded as a safe investment option for public, and it kind of guarantees you interest rates. There was a question of lately, a gentleman said that we are investing in FDs over here, and it provides a special interest rate for the senior citizens. We all have seen that, right? The point is, an exposure savers to little to no market related risk with the advantage of income tax deductions. On an average, the NRE fixed deposit yields 7%, which when you see now in dollar denomination, US Treasury yields, 2-year Treasury yields are giving you 4.28% over Treasury bonds. Now, when we see the current economic conditions, fixed deposits are not the safe haven anymore. Right now, fixed deposits cannot protect you from the inflation. And last September, it was around 7.4%. So 7.4%, just the inflation. I'm not even counting the currency depreciation. Inflation numbers have remained above RBI tolerance of 2 to 6% bandwidth. Then oil prices are still going up, and India gets a major disadvantage if oil prices continue to go up. Central Bank of US is still continue to go and increase interest rates, right? That will increase, that will widen the trade deficit. It will possibly weaken the rupees more. And now we can see that in last 6 months, the Indian rupee has depreciated around 8%. So if you had any fixed deposits back then, most of your gains are wiped out because the currency has depreciated. Now, US will, the expected funds rate around which US wants to keep the interest rate is around 4.5%. So central bank will continue to be more hawkish. They have already raised rates by 2.75%. They will continue until the rate reaches to 4.5. And on the other, when we look at the Indian central bank, is likely to be cautious. They have spent a lot of money in defending the currency, and we are expecting the forecast for INR, it could still be weaker. And that is something which we have to see, that when we are investing in INR, whether you are an NRE or no, or whether you are an NRI or no, inflation is eating it up. And these are some US Treasury bonds, and you can look at their coupons, you can look at the maturity, yield to maturity, which is around 4.4%, 4.4%, 4.18, 4.26 on an average. And a lot of these maturity dates are around 2025, 2024, 2025, 2027, 2026. We're talking about another 2-3 years. And all of them are dollar denominated bonds. So again, if you're already an investor who's investing in bonds, really good, not a problem. If you're doing only fixed deposits and not investing in bonds, here is another leg for you, right? When you come and sit with us and speak with us, we'll explain you about how you can invest into these. What is the minimum investment size? Are there any bond funds you can invest in? And this really protects your money. Today, if your currency depreciation is 8% and all you're getting from your fixed deposit is 7.5, then your basically your real rate of return is still really less, right? All you look at is the nominal rate, which is not right, because the money is still being eaten up by inflation. So again, as I said, do not just exhaust all your savings into one, but segregate it. You have to diversify it. And once that happens, once you diversify, you will see, you will not go through those sleepless nights, because you know that, okay, one part of my portfolio is not doing well, but then there is another part I'm gaining somewhere. And that's all these strategic sessions are all about. Before I leave, since this is a month of earnings, I'm just going to leave you with one more strategy, which we especially do in earnings season. And this is again something which is based on, again, getting exhaustive data and trying to find a pattern through it. And this is called price action analysis. We have done that in the past. And I'm just going to give you an example. Not that we are, this is not the recent one, but as I said, that only the treasury bond strategy is something which we have, recently prepared. But there are a lot more other strategies which are still going on, and they are related to crude oil, they're related to natural gas, and probably one session will never be enough. If you're interested more, we can sit in the office and discuss more about this. But then I wanted to discuss one of a kind. So we talked about pair trading, we talked about seasonality analysis. I showed you about treasury bonds over FDs. And now I'm going to tell you about price action analysis, which is a very popular strategy during the earnings season. Let me just switch the screens here. Okay, now I'm showing you a price action analysis of two stocks. Now, price action analysis is nothing but understanding how the price, or basically on the basis of, so let me just explain you the strategy, and then you see how the strategy works. every public company or every company which is listed comes up with an earning report, and that happens every 3 months of the year, just like a report card. How we used to get our report cards every year, by the end of the year, the companies come up with every 3 months, most of them. And if you see, there is a company called Walmart, there's a company called Take Two Interactive. What I did was I found out statistics and understood that if now Take Two Interactive, for example, was coming up with the Q4 earnings report. Now, after every earnings, the stock prices move in a direction, because when results come, they talk about earning per share, they talk about revenues, they talk about future outlook. And after all of those earnings, we see the stock price moves in either direction, depending on how good or bad they were, whether they matched the Wall Street expectations or not. Take Two Interactive, for example, was about to come for Q4 earnings on 17th May. Now, we saw that how Take Two Interactive has reacted if a day after the earnings come, or sorry, a day before the earnings come, and the day when the earnings are displayed, how the stock price moves one day before the earnings and after. And you'll be surprised, in last 10 years, every fourth quarter, if you buy Take Two Interactive a day before the earning and sell it after the earnings are declared, you could see an average return of 3.3%. How that is possible? Again, not a guaranteed return, as I said, an average return. Look at this pattern. From in 2012, 6%. This is a price movement which happened for Take Two Interactive a day before the earning and the day after earning. 2013, 1%. 2014, minus 8%. You lost there. But 2015, 18%. 2016, 5%. 2017, 7%. 2018, 1%. 2019, 4%. 2020, lost again 6%. 2021, 7%. So the probability, out of 10 times, 8 times Take Two Interactive has shown positive price action after day before the earnings, and if you hold on to the stock the day before the earnings and you sell it the day after. So this was about Take Two Interactive. Then there was Walmart, which showed something really different. Now this was a 50-50% probability here, right? So price action analysis is all about finding out these companies and then looking at their quarterly results, not just for the year previous, but 10, 12 years before, just to see that if I would have bought the stock a day before and sold it the day after, and if I had done this for 10 years, how the prices have moved. So if Facebook shares before earnings was $100 and after the earnings came, it was 110. And if this pattern was repeated in 10 years, every fourth quarter, then rather than speculating, I would be more comfortable picking out these stocks, looking at the probabilities of gain in price, and then investing into it. So again, guys, this is called price action analysis strategy, and all of them, as I said, are a part of these things. I told you about Nasdaq in South Africa. I told you about treasury bonds. I told you about seasonality of sugar or any other seasonality strategies which can come up. And if you see, if you talk about stocks, there is price action. You talk about commodities, there is seasonality, there is pair trading, right? If you talk about bonds, right now they have the advantage over the fixed deposits. Like this, there are so many other strategies which are being built around, and it's on, let's say, natural gas spot and future contracts. It is done on coffee Robusta and coffee Arabica, two very, very connected products. So all of these strategies, we are building this every day, looking at the market perspective, and that's what um, financial management, or that's what risk management is all about. It has nothing to do with making profits. It has more to do with minimizing loss and managing your risk. And I think, again, these sessions we continue to do. If you like these sessions, or if you didn't like these sessions, please review us on Google either way. And I'll be available on for a one-on-one session. I'll be available on a Zoom call as well, if that is comfortable for you. And if you want to know more about these strategies, you want to have more flyers, please talk to your relationship managers. We have so much literature that we can definitely send it to you and even explain it to you, right? So before we end the session, as I always tell this to everyone, that on behalf of Century Financial, my team, and my family specifically, a big word of thanks to anyone who is into the medical field, nurses, doctors, midwives, fast responders. All of you have uh, risked your lives throughout the pandemic, and pandemic, as much as we want to feel it's over, but then I'm sure there is always a risk out there. And in 2020 we got to know that who are the real heroes. And um, I still continue to convey my regards if you are one of them, or if you have your children or your spouse or your friends who are in the medical area and risking out their lives. So once again, thank you so much to everyone who has attended this session. We'll meet you next week with a completely different topic, with something really different, and new strategies, new ways of understanding financial markets. To all my attendees over here, wish you a very happy Diwali. It's a festival of lights, and I hope that it brings a lot of light in your portfolios. So have a great night, and please keep investing and remain invested. You just need to know the right area, just the right industry. So once again, see you next week. Thank you, and you have a good night.